and small caps, there is a bit of overvaluation there.
Caution which should be exercised on the small cap and mid cap side of the market.
I want to give a caveat. The small caps are volatile. They're very dangerous. That's not for the hearted.
Hi everyone, this is Mohit Pariyar and today we are going to discuss a very trending topic in the market. Are the mid-cap and small-cap stocks overvalued? Let us analyze and find out. Since March of 2023, the Nifty Midcap 100 index has raised from 29,200 to 47,838, a 64% rise in a matter of 10 months. And then we have the Nifty Small Cap 250 index, which has raised from 8,492 to 14,589. Again a 72% rise in a matter of 10 months. Now the simplest way to check whether the markets are overvalued or undervalued is to compare the current PE ratios with the historical PE ratios. To give you a comparison, the average PE ratio of the Nifty over the years has been around 20. And the current PE ratio of the mid-cap index is 25 and the small-cap index is 28. Now if we compare these to the historical average PE ratio of 20, the mid-cap and small-cap indexes look slightly overvalued. However, just because a stock is trading above its PE ratio or it is trading below its PE ratio, do not make that stock overvalued or undervalued. Because markets are valued based on the expectations of what is going to happen in the future and not on the basis of what has happened in the past. For example, there is an air in the market that HAL is about to get a huge defense contract from a foreign nation. Now, even before that contract is actually signed, the price of the HAL stock starts to increase. This is because market is expecting HAL to perform good in the future because of this new contract. Now, to understand these future expectations of the market and whether they justify the current valuations or not, we need to do some fundamental valuation and analysis. Keeping this in mind, let's begin. The fundamental valuation revolves around three things: expected future cash flows, cost of capital, which is the cost of raising funds by the investors, and the risk premium, which is the additional return you want for taking the risk of investing in that particular asset. The cost of capital and risk premium are together known as required rate of return. So the valuation of the company is nothing but the expected future cash flows divided by the required rate of return. For example, the company is expected to make a cash flow of 1 lakh rupees in the next 1 year, and after that company is going to dissolve. And the required rate of return is 10%. So the value of the company would be 1 lakh divided by 10%, which comes out to be rupees 10 lakhs. Now why I made you understand this concept was because from here on the topic of discussion throughout this video would be around these three components of valuation only. For the purpose of analysis, I have taken the 10 highest weighted companies from the Nifty 100 Midcap Index and the Nifty 250 Small Cap Index. So let us begin with the first component of valuation, which is the future cash flows. In the top 10 companies of the Midcap Index, there was an average increase of 29% in revenue in the financial year 2023 compared to financial year 2022. And for the top 10 small cap companies, there was an average increase of 26%. Also, if I try to forecast the revenue of financial year 2024 by converting the data released by these companies till now, revenue can be expected to increase by 17.5% for the top 10 mid caps and by 26% for the top 10 small caps. If you want to have a look at the financial statements of these companies, you can easily find this data on NSE website. However, despite increase in revenue, 5 out of these 20 companies had negative cash flow from operations. This means that these companies are having difficulty in converting their profits into cash flows. And despite this, there has been an increase of 181% in the prices of shares of these companies in the last 1 year. So for the first component, future cash flows, we can say that the revenue of the mid-cap and small-cap companies have been increasing at a very fast pace. And looking at such high growth rate in revenue, market is expecting these companies to perform good in the future, which has been pushing the stock prices. However, the fact that some of the companies are not able to convert their profits into cash flows seems to be getting overlooked. Now let us move towards the second component, which is the cost of capital. You may think of cost of capital as the rate of interest at which you can borrow money to invest in a stock. So changes in the interest rate at which money can be borrowed has a huge impact on the required rate of return used to discount the cash flows. A rise in interest rates will increase the required rate of return and the valuations of the company will fall and vice versa. In short, there is an inverse relationship between interest rates and valuations. Now the thing on which the interest rates in the markets are dependent upon is called repo rate. Repo rate is the rate at which RBI gives loans to commercial banks like HDFC, ICICI and SBI. And these commercial banks charge some premium over that repo rate and advance loans to the general public and businesses. The current repo rate of RBI is around 6.5%. And since the last 2-3 years, there has been a constant increase in the repo rates by the RBI. Since April of 2022, the repo rates have increased from 4% to 6.5% in May 2023. However, there is an expectation in the market that interest rates have peaked out and they would start to fall from 2024 onwards. If interest rate cuts are announced by RBI, it would further boost the fundamental valuation by confirming the start of downfall of interest rates. Therefore, the expectations of repo rate cuts is supporting the current above average PE ratios of these small and mid caps. Now let us come towards our last component, which is the risk premium. Similar to cost of capital, a higher risk premium would increase the required rate of return and in turn decreasing valuations and vice versa. One of the biggest risks in the mid cap and small cap stocks is the liquidity risk and impact cost. The average market cap of mid cap stocks is between 5 to 20,000 crore rupees and the average market cap of small cap stocks is under 5,000 crore rupees. The average promoter holdings in these stocks is around 50 to 70%. This means that the stocks traded in the market are only 50% of the market cap, which further increases the risk of these stocks being operated. Also, especially in the case of small cap stocks, there is a high impact cost as well. For example, if a stock is on a lower circuit, you cannot sell that stock until its value is depreciated by 40-50%. I feel that risk of currently investing in these stocks is slightly on the higher side. However, investments in these stocks are mostly made by small retail investors who do not understand the risk as much as the big investors do. Therefore, the prices of these stocks are rising even if they can be a risky investment. So, in conclusion, yes, the mid cap and small caps are currently trading above their historical average PE ratios, but this over average market price is also backed by high growth rate of revenue and the expectations of market interest rates to fall in the future. Therefore, there is no decisive reason to tell whether these stocks are overvalued. However, risk of investing in these stocks remain high, especially in the case of small cap stocks. You can allocate your investments into these stocks according to the risk you are willing to take. I hope this analysis will help you in making sound investment decisions. Thank you for watching.